How much money would you really have to have invested to be able to live off of the dividends forever? In this video, we're gonna take a look at that, and I'm also gonna break down a few points that most people making videos about this topic completely overlook. So for starters, how much do we need as an income in retirement? According to most statistics, the average cost of living in the US is somewhere in the $2,500 to $3,500 range per month. So let's assume that we need $3,500 per month in after-tax dividend income. And I say after-tax because dividends are taxable in most jurisdictions, which is something a lot of people overlook. Now, tax rates vary by country, by state, and also by how much you make from other sources. But if this dividend income is the only source of income you had, then I think we could bump this target up to around $4,000 per month. And that would be enough to cover the taxes and still leave you with $3,500 in spendable income. And if you don't think you could live off of that amount, or if you live somewhere where the taxes on dividend income are higher, then you can adjust the figures for yourself. But I think that most people could get by on 3,500 USD per month as a minimum just for baseline living expenses, especially if you lived in a part of the country that is cheaper, or if you move to another country altogether where the cost of living is really low, for example, somewhere like Mexico. Okay, so the actual target is $4,000 per month or $48,000 per year in dividend income. How much do we have to have invested to get there? Well, let's consider two different possible approaches. The first would be investing in a conservative dividend portfolio, and the second would be a more aggressive portfolio. In the conservative dividend portfolio, the yield or the amount that you'd get paid for your investment would be lower, but it would also be safer, meaning that you'd have less risk of losing your capital that you invest. And this conservative dividend portfolio would include things like government bonds, ETFs, index funds, real estate funds, and maybe a few select dividend aristocrats, which are companies that consistently pay out dividends and increase dividends over a long period of time. Some examples you can see include Walgreens, AT&T, or the 3M company. A conservative dividend portfolio might yield something like around 3% per year. And what amount would you have to have invested in a conservative dividend portfolio to yield $48,000 per year on 3% dividends? The answer is about 1.6 million. But in the aggressive dividend portfolio, you would actually need much less, although it's important to note that there's a higher risk with the capital here. And a more aggressive dividend strategy would mean staying away from things like government bonds and probably most dividend ETFs, unless they're high yield dividend ETFs, but also picking individual stocks of companies that pay high dividends. For example, here's a list of 9 different companies that are all paying at least 9% per year in dividends, going all the way up to 12.4%. Now, you obviously would not want to put all your money into one single company that's paying a 12% dividend yield. It's too risky. You could lose the actual principal of your investment if the equity in the company takes a hit to the negative. Even if you're making 12% on dividend yield, it's not going to make up for the fact that a company could lose 20 or 30% in the price of its stock. And so by taking a diversified approach, but still investing on the more aggressive side when it comes to high yield dividend ETFs or individual stocks, you could definitely target around a 6% per year dividend yield on a diversified basis. And so that means in the aggressive dividend strategy at a 6% per year yield, you would only need around $800,000 invested to be able to pull $48,000 per year in dividend income. Okay, great. Easy, right? Well, actually, it's not so simple as that, because there's a few more factors that we have to account for. 2 of which are going to hurt us, and 1 of which is actually going to help us. Let's start with the bad ones, like inflation. So if we want to account for inflation and hedge against the fact that every year the purchasing power of $1 is worth less than it was the previous year, then we also have to add in a margin of safety by reinvesting at least 2% of the dividend income that we make in order to be able to scale our income over time with inflation. And I say at least an additional 2% per year in reinvested dividends, because currently the inflation rate is above 2%, although over the long run, hopefully it will come back down closer to around the 2% mark. So if we needed to reinvest 2% of our dividend income into the portfolio in order to allow it to grow over time and to beat back inflation, then that means in the conservative scenario, we would only be living off of actually 1% yield. And if that were the case and we had to live off of only 1% dividend income in the conservative investing approach, then we would need $4.8 million invested in order to be able to pull out $48,000 per year. Now, this would allow us to pull out $48,000 per year in perpetuity for as long as we're living, but still, that is a heck of a lot of money to have invested. In the aggressive portfolio, the situation is not so bad because after we've reallocated 2% to the inflation hedge, that means we're left with 4%, 4 of the 6% for our actual income. And under those circumstances, then we would need to have $1.2 million invested in the aggressive dividend approach to be able to live in perpetuity and hedge against inflation. But now let's talk about capital risk and dividend risk. For starters, in some cases, high dividend paying companies will pay you 8, 9, 10% per year in dividends, but the price of the stock will not go up over time. In fact, in some cases, it actually goes down. And the reason for that is usually because if they're paying out all of their cash in dividends to shareholders, it means they're not reinvesting that money into the business to grow it. And generally speaking, although definitely not in every single case, but generally the higher the dividend yield of a stock, the lower the likelihood that over time there's going to be price appreciation in the value of the company. Another factor to consider is that sometimes companies stop paying dividends or lower the amount of dividends or at least pause dividends during periods of recession or downturns in the economy. And so the capital risk and the dividend risk has to be accounted for as well. But it's a bit more difficult than inflation because it's really hard to predict what the price of a stock is going to do over the next couple of years or over the long term, as well as whether or not they're going to continue paying a dividend. But the smart thing to do is to definitely add an additional contingency percentage to an investment portfolio as a margin of safety to protect against downturns in the price of one of your dividend stocks or in the off chance that they actually stop paying a dividend. So let's say we were targeting the aggressive dividend investing portfolio. Well, instead of having 1.2 million invested, it's probably smart to add an additional 10, 20, or even 30% contingency in order to account for any unforeseen circumstances. So having something like $1.5 million invested at a 6% yield would be safer. But now let's talk about something that will actually help with your dividend retirement, which is the concept of yield on cost. Basically, what this boils down to is the sooner you start building up a dividend portfolio, the better, because your dividend yield is actually likely to go up over time. So for example, let's say you invested $100 today to buy one share of a dividend aristocrat that paid a 4% yield, so $4 per share. And since it's a dividend aristocrat, that means it continually increases its dividend over time. So let's say over 10 years, the dividend increased from $4 per share to $6 per share, but the yield stayed around the same at 4%. Well, that means that the company shares would now be trading at around $150 per share because 4% of 150 is $6 per share. But the thing is, your dividend yield is actually higher than 4%. Your dividend yield is now 6% because of the yield on cost. You only paid $100 for that share 10 years ago. You didn't pay $150. And that means that you need now significantly less money actually invested in order to be able to retire than somebody that's coming in today, 10 years later, and trying to buy up the same portfolio in order to have the same amount of income. And so going back to our target, we've established that in an aggressive portfolio where you could get 6% per year in annual dividends, you'd probably want to have at least $1.5 million invested. But that does not mean that we had to pay $1.5 million for it. Because if we had started building up that portfolio 10 or 20 years ago, then we could be at that 6% yield or even much higher by investing a lot less than the $1.5 million it would cost today to purchase it. And it also means that in a high yield dividend portfolio, you don't necessarily have to be YOLOing into super risky, high yielding dividend stocks, because over time, the rate of your dividend yield on cost will go up, even if you're buying into relatively safe dividend companies. And so really the key takeaways here are that if you're planning to build a retirement portfolio based off of dividend income, yes, it's going to take a lot of money. You're going to need to have at least probably $1.5 million invested, if not more, in order to be able to safely live off the dividends. But the other key takeaway is that the sooner you start investing in a dividend portfolio, the better, because your yield on cost will be higher and you'll have a higher likelihood of actually being able to live off of your dividend income. Now, if you want to see what the 7 steps you can take today are that will increase your chances of being able to retire early, then click here. Thanks so much for watching and have a great day.